Manish Sonthalia is with us, Chief Investment Officer at Emkay Investment Managers. Manish, good morning. Good to have you here. Thanks for your time. You've been bullish. You've been saying, well, the market's going to bounce. It's bounced and bounced sharply. What's your sense, Manish? Is there enough to do in terms of individual stocks from here, given earnings and growth visibility, and in which areas?
So Prashant, 22,000 has held, and I have maintained that 22,000 won't get decisively broken. That's played out. I think for the next 1-2 months, till the point in time you have clarity on the tariff, and basically that 90-day pause, out of which 15-20 days has already gone. So next 1-2 months, I think markets are going to be range bound between 22,000 and 25,000. Can't really be seeing an outbreak beyond 25,000 given the macros that we are in, given that earnings season is somewhat okay, not very great. So I would believe that we'll consolidate. And right now it is more about institutional buying. The banking space, the heavyweights, Reliance. You have the technology space after the correction. So I think it's more to do with smart money buying in and around the indices, the heavyweight indices level, rather than individual stocks at this given point in time. So it's more to do with index management. Currently, now that we have bounced back 10% from the lows, I would believe that you'll see broadly the heavyweights on the index largely play out on the positive side till about that 25,000, and then we'll be basically consolidating around that point.
Manish, hi, morning. Great to have you on. I know you won't talk stocks, but maybe we can get a indicative direction. I'm looking at Bajaj Finance this morning. It's down 4.5%, almost 5% actually. And the only, I think, crease in the earnings, if one can find, is maybe the fact that they have taken certain ECL provisions. And I think, that's the talk point, whether credit cost indeed is peaking out now or not. 1.85 is what they're guiding for. But in general, I mean, the stock has done so well, right? I mean, look at the way NBFCs have rallied in the last 2 odd months. What would you do with the NBFC space? Would you go here? Would you stick to banks? And how does one look at, and Shriram Finance was the other casualty in this earnings season. So it's been a little odd for these large non-bank lenders. Your thoughts?
So first of all, numbers were pretty okay for Bajaj Finance. I would believe it's to do with, the maverick, Mr. Rajiv Jain, who is now becoming the vice chairman. He has led the company from the front over the last 20 years. And now, he is going to be the vice chairman. So I think market is somewhat, not used to not hearing Rajiv Jain on conference calls and so. So that's one point. Secondly, credit costs are definitely, something to worry about as far as the Bajaj Finance numbers are concerned. Nothing alarming because they are still guiding for AUM growth of 24-25%. It's to do with valuation. The stock has run up so much. But I think, it's nothing fundamentally wrong with the company. They are guiding pretty good growth. But the valuations are pretty full at these prices. So maybe that's the best time to take profits. I could read just that into, Bajaj Finance. I mean, the NBFCs as a whole, whether you look at Chola or Shriram, there's some concerns around the NPA numbers. Even Chola numbers, NPAs were slightly elevated. Bajaj was already a disappointment as far as the ECL provisions are concerned. Of course, they called it out as one-off, but markets have their own reading of the same. And similarly with Shriram Finance. So, the sector remains in a sweet spot because repricing of deposits are happening immediately for NBFCs in line with lending rates. So they are able to maintain their spreads much better than banks because, liabilities on banks will come down over a period of time. Whereas lendings, reset on MCLR, EBLR is happening immediately. So,
so buy or not buy? Sorry, coming in over here to try and sort of squeeze in more in the time. Point is, when you see these sharp dips, whether it's, Chola, more importantly, Bajaj or a Shriram, is it all passing, manageable? So buy the dip or stay away?
Let's buy the dip. There's no doubt about it. There's nothing alarming about these banks or NBFCs, just that out of profit taking after they have rallied 20-30%. That's about it.
Okay. Hi, Manish. Good morning and good to see you, Ben. If I remember correctly, you were quite positive on capital market related plays as well. And from that space, a couple of stocks have done very, very well. But now valuations, they could be a bit of a headwind. Currently,
Absolutely.
what are you bullish on from here on? Because a BSE, well, it saw a sharp correction of 30%. Guess what? It made a fresh all-time high yesterday. So what are you bullish on this theme now?
So, it's got to do, I can't understand the valuation difference between unlisted NSE and the listed BSE. BSE is trading at 90 PE plus, and, unless and until earnings surprise massively on the positive side for BSE, even that's not, quite doable currently, given the regulation change around settlement dates. So, difference in NSE and BSE valuations, 30 P out there, out here you have 90 P. You have 90% market share, you have broadly 10% market share. I think on the BSE side, it's more to do with bonus stripping, all of that just comes about. But capital market plays, etc., looks quite decent in this downfall. I'm particularly more bullish on the depositories, RTAs, asset management companies, whatever asset management companies have reported numbers. They have all gone up from their lows. And I think from a medium-term perspective, they all look quite good. Even the broking platforms, selectively, wealth management platforms, I think they are all investable from a medium-term point of view. You're getting it at lower prices, but just keep in mind the valuations, exorbitant valuations, 50, 60p won't hold. But anything like 25, 30, 35p, these platform companies are likely to create wealth in the medium.
Okay, all right. I think if I remember correctly, you're also positive on health insurance.
Yeah.
That theme has not yet played out, I think so. Tell us more.
So Star Health reported numbers yesterday. Underwriting profits were disappointing. Investment gains were pretty okay. I think it's a work in progress. The fact is that you are getting at 15, 17 PE multiples, and increase in premium rates around the corner. So claims ratio for some of these leading health insurance plays are best in the industry, 65 to 69 odd percent. And plus you're looking at increase in premium rates. That would mean that you are looking at implied growth rates of around 25 to 30%, and you're getting it on multiples of 15 to 18 times, which is basically less than 1 PEG. I think a good investable idea, without too much of risk.
All right, interesting call out there, because the IPO was at around 900 rupees. The stock has come down to under 400 rupees. But you believe post the correction and given the tailwind that it has, you believe valuations now are more palatable. So that's in Star Health.
Okay, got it, Manish. We're really, relishing it this morning. You're giving such wonderful perspective on these, big movers, which are of all, earnings driven. So I'm going to take my chance with one last one with you. Trent. Just your take on the business. Dream run, but is it over? Is it really over? Because you cannot sustain at maybe 70, 80, 100% growth rates. And the stock is still at 70 times forward earnings. What should current investors do? Same question. Buy the dip or just stay away?
Trailing 12 months is 100p. So I think it's it's got to do with valuations. There's nothing wrong with Trent. Great company. But 15% margins, this time around they have reported 16% margins. Whether that's going to sustain, that's the big call. But execution holds and valuation holds. If the valuations come down to less than 3 times price earnings growth, it could be an investable idea. But currently, valuations are concerned.
Which would be where 3 times PEG for Trent would translate into what sort of CMP, roughly?
100p, so it's grown at 35% on the top line. So multiplied by 3 times, you get 100p multiple.
Okay.
Right. Zomato, Manish, any thoughts? Zomato, Swiggy?
I think, whatever narrative is coming around in social media regarding, problems at Zomato, still I think they would be the last man standing, given everything. A lot of positives as far as operational leverage is going to play out for them. And yes, opening of dark stores and discounting by competition would take some sheen off the Blinkit SOTPs. But even then, there is some margin of safety from where we are in Zomato. So I'm not negative on Zomato at all. In fact, it's one of our portfolio holding stocks. And the simple understanding is that, this is basically irreversible. The quick commerce and food ordering that has become a habit. India wants everything in 10 minutes. That's become a habit. It's not reversible. That's one. Secondly, if there's anybody who's going to have the economies of scale and would be the last man standing, it's going to be Zomato. Yes, Amazon has deep pockets. You have a Flipkart which has deep pockets. But to get the unit economics right, you'll have to burn a lot of cash. And I mean, it's an evolving situation, but currently it looks like that, Zomato is in the best form and shape as far as the growth and the valuations are concerned.
All right. Thank you very much. And just platform companies, right? I mean, you start with capital market plays, and I mean, these are, of course, in the different space, but all kind of tying in with broadly consumption and consumption growth. Thank you very much, Manish, for joining us. A good conversation as always. Let's